Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Mitch Berlin, EY America's Vice Chair with Transactions and Strategy. He joins me to discuss how companies are dealing with the M&A environment as it's expected we could go into a slowdown for 2023. Mitch, it is great to have you with us. Welcome to Trade Talks.
Thanks, Jill.
We saw a flurry of large acquisitions in the past couple of weeks to wrap up 2022. What was your thoughts on the M&A markets throughout the whole year?
So overall, 2022 will finish behind 2021, but it's important to know that 2021 was a record-breaking year. In 2021, we closed about 20,000 deals. Overall markets did. In 2022, we'll end up at about 15,000 deals, and that puts us back at our pre-pandemic levels. The one area that we did see an increased number of deals is in the area between 100 and 500 million. I think that's primarily because those deals can fly under the radar of regulatory scrutiny, and they were, quite frankly, just easier to finance.
Right. And Mitch, you know, the sentiment is overwhelmingly negative heading into 2023. So how are companies adjusting their M&A plans for a slowdown?
Well, I think they've already adjusted some of it just because of the increased interest rates, the persistent inflation, and the higher cost of capital. I think what we'll see in 2023, Jill, is really, a tale of two halves. The first half of the year will be slow, and then I think as things rebound, hopefully, I'm most likely we will dip into a slight recession in the beginning of the year. Hopefully, it will be short and not too deep. And as things rebound in the second half of the year, we'll see M&A activity pick up again.
Right, and one trend we saw in 2022, these large companies that were carving out pieces of the company. Do you think we could expect that again in 2023?
Yes. I mean, I have to tell you, I've been doing this for 20 years. I've never seen the level of activity that we have right now in divestitures, particularly around tax-free spins. We are signing up to do at least one tax-free spin a week for the last 12 weeks. And Jill, that's unprecedented. We've never seen that before. And the reason for that is that CEOs are trying to get their house in order. They're doing portfolio analyses, and they're looking and they're saying, these are businesses that are either non-performing or non-core, and we could shed them and raise capital. Also, we do see a trend towards businesses that are diversified becoming more pure play businesses, because it's much easier for an institutional investor to understand what they're investing in if it's a pure play industry, a pure play business that operates just in one industry versus a conglomerate or diversified business that operates in multiple industries.
Yeah, it's so interesting. It's such a reversal of the trend when companies were looking to be these huge multinational conglomerates, and now they're breaking up for the sum of the parts. Certainly a strategy shift over the past couple decades. Now, the tech industry faced a number of challenges this year, whether private or public markets. What can we expect in 2023 as it relates to the tech sector? And what other industries do you think are going to be active?
So the tech industry did face a number of challenges, but they're still the dominant player in M&A, and they will close this quarter again as the top player in M&A, and that's 10 quarters in a row. So we're still going to see them as active players in 2023. And the reason is it's not just tech companies investing in tech companies, but it's non-tech companies investing in tech companies, because they do need to digitize, do need to accelerate innovation. And the way to do that, quite frankly, is through digital enablers and such. And so we'll see tech still be a dominant player. Large pharmas were active this year. They have strong balance sheets, and they're able to take advantage of the higher cost of capital because they're sitting on cash. We'll continue to see them play in 2023, and oil and gas was hot as well this year. And as long as the commodity prices stay where they are or continue to increase, we're going to see oil and gas active in the M&A markets too.
What other notable trends took place in 2022, and how do you expect them to play out in the new year?
Well, private equity is always a big player, as you know, in M&A. The first half of 2022 was very, very active for private equity. And then they took their foot off the gas the second half of the year. And again, it's because of the persistent inflation, the increased interest rates, the higher cost of capital. And we would expect that similar to the corporates, they will enter the market, not only when capital becomes cheaper, but when valuations decrease. So we'd expect to see them re-enter the market sometime spring or summer of 2023. ESG businesses are always popular. There aren't that many of them. So when they become of scale, particularly those that play in the sustainability space, they will be snapped up. And then the other trend that we're seeing is the consolidation of low margin businesses and industries. And so we saw a start this year with food and ag companies We'll see an increased consolidation in low margin businesses because it's one of the only levers they have left to improve margin is really operating through scale and playing on the scale card. And to do that, they need to consolidate.
All right, Mitch, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.